In this video, you'll see unique insights into what happens when you drip feed during a recession. Is it better, worse, or does it matter in the long run? Let's find out. Previously, I've shown how drip feeding investments isn't the fastest way to grow your portfolio, but one of my viewers raised an interesting point. What if you started drip feeding during a downturn? In theory, because you're spreading out your investment across different points in time, your losses would be reduced as opposed to lump sums at the beginning of the period. And that is correct. You'll see that in the data which I got from running simulations on my modeling tool. We're jumping into the S&P 500 index fund to assess different drip feeding frequencies. Our test runs begin at the onset of the 2000, 2008 and 2020 recessions, that is the dot-com bubble, global financial crisis and COVID-19 crash respectively. In the model, investments happen at the beginning of each period. For example, if the frequency is annual, investments occur at the beginning of the year. If it's weekly, it happens at the beginning of the week. The other thing not to be confused with is that this is not a single lump sum investing, but an investment sum, in this case £1,000, spread out over different frequencies. So let's look at the dot-com bubble crash. This is what your investment would look like at the different frequencies. Not much difference in the long run actually. If we zoom in towards the final period, that is December 2022, you can see that there's hardly any difference, with the half-yearly frequency slightly underperforming by 1k, so roughly 1% less. But how could that be? The math says that more regular frequencies outperform less regular ones during a recession. So, according to the theory, shouldn't the annual investment frequency dramatically underperform? Let's zoom in at the beginning to show you what's actually happened. This is how the portfolio starts, with £1,000 invested at the start of the year in the annual frequency, £500 for half yearly, £250 for quarterly, etc. So that's why you see these step functions. If you follow the teal colored line, which represents the annual frequency, that drops during the recession shown here, while the other frequencies catch up and overtake it towards the end of the year. This happens because of the dollar cost averaging. You're buying an average of the falling prices. So that math is actually right, and you see this effect in the data as well. In fact, the annual frequency performed the worst out of the lot, underperforming all the way until 2015, where it finally manages to overtake some of the other frequencies. That's like 15 years of underperformance. But how did the annual frequency eventually catch up? Shouldn't it be screwed forever? What I mean is that in a race of compounding, usually if you're behind at the beginning, you've lost irrespective of the time horizon. For example, £101 will always grow faster than £100. So here is the dilemma. In 2015, when the annual frequency was behind, how did it manage to grow faster and overtake the other frequencies? I mean, they're all investing in the same index. Well, I discovered this effect before in my earlier video. The earlier you invest more lumpy sums of money, the more compounding happens. In this case, the initial value in 2015 doesn't favor the annual frequency, but over the next years, as strong growth returns, it favors it. That's how it can actually catch up. So now we understand why drip feeding at smaller intervals during falling prices is better, but not when prices are rising. So the analysis was for the period of 2000 to 2022. What if you started during the global financial crisis in 2008? This is what it looks like, and same story, the annual frequency underperforms during the recession, but interestingly in the end the annual frequency comes out slightly on top. What if you started investing right before the COVID-19 pandemic? Same story, except in the end the other frequencies came out slightly on top. But is the same true if we repeat this experiment with the Nasdaq 100 ETF? Well, the same story really. Monthly frequency wins for the dot-com bubble period, annual wins for the global financial crisis, and half-yearly wins for the COVID-19 market crash. In short, there is no clear winner. Now, I have to point out that the limitation with this analysis is I'm picking the recession year as a starting point, not the exact peak before the recession. But that shouldn't make a big difference because bubbles build over time and a few months of appreciation hardly makes a big difference. Therefore, with respect to the S&P 500 and Nasdaq 100, we saw that the frequency of investment does not really make a huge difference in the end. Any superior performance is marginal and not really worth making a big fuss about. In reality, things like transaction fees and investment convenience probably matter more. And that's good news really, as that means you can relax knowing that the frequency of your investments won't probably make you lose out much, at least when it comes to the indices we explored. Now, I know we went deep with the analysis, that's because what it took to really see the true picture. Insights like these safeguard your portfolio, and you know what else does? A retirement emergency fund. And this video tells you everything you need to know about it. Thank you for watching and see you next time.